Richard asked a question. In a married put trade, I'm trying to better understand time decay profitability and how I track and manage it in my portfolio, earnings tracking with PowerOptions. No priority for this, please. Okay, Richard, we'll go ahead and address this. Now, as I mentioned a little while ago, the married put approach. We're not using a 1 month out of the money married put. Richard, I know you know this. I'm just saying it to others in attendance. That's not our preferred approach. We're going to buy a stock, and we are going to buy a put option that's slightly in the money, 1 or 2 strikes above the stock price, excuse me. And we're going to control our risks to single digits, 4, 5, or 6%. What makes this approach even plausible? Why am I taking Eldorado Gold, Aris Mining, IAG? I'm looking for AGI to see if she's still in here, because that's the one I'm in. Amphimol, Newmont Mining, heavily dominated here on our default search. Wheaton Precious Metals, Goldfields. NVIDIA is in there as well. Okay. So let's just take NVIDIA. I'm interested in trading NVIDIA. I think it's still going to go up in price. Now, I could do a bull call debit spread. I could take a look at Mike's bull put credit spreads on NVIDIA, look for that 85% probability with that 14% return. No, I'm risking 100% on that leverage trade. I got to control my risk and only invest, a small portion of my portfolio into that credit spread, for example. Or I'm bearish on NVIDIA. Hey, the market's down. I'm going to do a bear call credit spread. But I'm long-term bullish on AI, for example. And I think NVIDIA is going to go. I think this is a good buy point now with some of the decline that's going on. Maybe Goldfields are too, but we're gonna wait and see what that is. All right, I could buy the stock right now at 191.13. I could do a covered call. I could sell the in the money covered call. We're showing that I can buy the August 200 put, 203 days out, midpoint price 27.93. Mike, what are you doing? You're buying stock at 191. You're adding almost $28 to the position. You've got a total cost of $219.06. You're not going to make a dime until the stock reaches $219.16. This has about a 0 probability of being profitable, even in 203 days. Okay, and you still got a high risk. This is a higher risk that I like to take, Richard, but it's single digit. It's putting us on the right side of the martingale curve and gambler's ruin. The worst potential that I could lose on this trade, even if NVIDIA fell to $80 per share, anytime between now and expiration, 203 days away, that's the absolute worst scenario, is that I'd lose 8.7% of, yes, $21,906 I'd invest in this. And again, why are you doing this? Your break even is $219.06. Of course, that's only at expiration. That's only if I hold the position all the way to expiration. Make none of the income methods or adjustments that are in the blueprint, which would reduce this risk and potentially bulletproof the trade over time. And I've got close to 7 months and with weekly options in order to do that. Okay? So, better understand the time decay profitability. At expiration, I do nothing. NVIDIA is below 200. I lose 8.7%. Profit, and that 8.7%, sorry, let me rephrase that. That 8.7% we're looking at, Richard, as you know, is just the time value of this put option. Yes, I paid $28. But $9 of that essentially is intrinsic value. I'm guaranteed to get that back. So my time value, my risk, the time value decay we're looking at in a married put is simply the extrinsic value or time value that we paid into the trade. Now, 3 core principles of radioactive trading. F.I.S.T, force ideal size trades. Why am I trading bull put credit spreads where I'm 87% success rate, making about 14.5, 14.7% and it is extremely profitable in my portfolio. But why is that only 12 to 15% of my total portfolio, not 50 to 60%? Because roughly every 14 to 16 months, an event comes around that cannot be controlled by stop losses or any alerts that I've triggered. The market falls, and that portion of my portfolio is down 50%. But since I'm only trading it with 12 to 15, when I close those positions out, even for a 50% loss, my portfolio is only down 6 or 7.5%, forcing an ideal size trade. The Married Put forces you into that. That's number one of the 3 core principles. Number 2, of course, is the at the money bell curve. Meaning when I sell premium, you look at any expiration on any stock, call premium, put premium, call cost, put cost. The time value, extrinsic value, is highest at the money. That's where we want to be selling in this range, 1 or 2 strikes out of the money, in the money from the current stock price. We want to be buying on the wings, in the money or out of the money, to be paying into lower time value, even though I'm paying into intrinsic, right? That's fine, because in this put, I'm guaranteed to get that back. So that at the money bell curve, we want to be buying out here on the wings. And you want to be selling at the peak to maximize the time value. The final portion, the 3rd core principle that you're talking about, Richard, is related to why am I going 250, 200, 210 days out in time? And that's related to the standard time decay curve. Let me redraw that. I've got a better image here, so let me just pause the screen here. Had it under a different name. There we go. And it's going to come up in Paint. I apologize for that, Richard, but let's go ahead and take a look. All right. This is the standard time decay curve, what you expect for an option. Now, yes, it is assuming no change in certain things such as volatility, stock price, but this is what you'd expect to see. The 120 days out, you see a low percentage of decay in your extrinsic value, the risk I took on the Married Put. And then the next 90 to 60 days, it's a little bit more. It increases at 60 to 30, but the most rapid time decay you expect to see is in the last 30 days. This is why in the blueprint, Richard, in your blueprint, we recommend in the exiting the RPM chapter is somewhere here in the 60 to 75 day range, 60 to 75 days to expiration of your put option. We recommend making the decision to either close the position if you have no more bullish anticipation of the stock going forward, or roll the put at this time before you lose all time decay property that you have remaining in the put option, and you're just trading intrinsic for intrinsic, or you're letting your put expire. So this is how the put time decay is set up. This is why we're going 150. So we're actually out here, as you know. Ernie's usually average is around 160 to 170. He's up here. My average time frame for a Married Put is about 210 to 220, about 7 months to 8 months, somewhere in that mid-range. So I'm out here. So even if in the first 90 days the stock isn't performing as I wanted, and I'm not meeting my target goals for the Married Put following the SIGA model, meaning I'm hoping to see a realized or unrealized 1 to 2% gain on the Married Put position in those first 40 to 50 days, then I might just close the position early, get out with a only 1% loss. How is it only a 1% loss? Because I've retained most of that 8% time value that I paid into the position, because I'm only 20 to 30 to 40 days in. Now that's assuming the stock didn't drop 50%. Stock dropped 50%. Of that 8.7% risk we saw in NVIDIA, stock drops 50%. I'm probably at 8, right? I'm probably at an 8% loss. I'm close to intrinsic value on that put. I get it. I know, I understand that. But there's still some time value remaining. So I'm not at full loss yet. And I could manage it if I chose to move forward. So time decay profitability. This is why we're far in time. Because if I just bought options, I was interested in NVIDIA. I bought a put option that was just 30 days out in time, whether it was at the money, in the money, like we do with the married puts, or out of the money, like we mentioned for that comparison against quote unquote the zebra trade that's coming up in that presentation for Lance, it's wasting money. It's a wasting asset. I'm going to see it decay 50% within the first 10 to 15 days. In the first 10 to 15 days of a radioactive trade, even if the stock stayed the same, volatility did not change. I'm probably only losing 0.3 or 0.4%, if that. So that's why the married put is set up. That's why a 30-day out of the money married put can help you if you're going through earnings and you just want to protect something real quick. I get it. That can work. Long-term for growth, this graph, I hope, helps explain the time decay profitability and how you can track it. You want to close following the blueprint when you get to within 75 to 60 days to expiration. That's when you want to make that consideration of what you're going to do. Now let's go back to that original NVIDIA position we were considering and see this time value in action. We bought 100 shares of NVIDIA at 191.13. From the default married put search, we selected the August 200 put with a price of 27.93. Now this makes the total at risk 1906. We're going to put 21,906 in the position, a guaranteed exit of 200 in the absolute worst case scenario, $20,000. So we're risking 1906 or 8.7% of the total investment. What can we experience with a change in this put option in our time value? And then 1906 is all time value. We paid 27.93. But we have that $9 or so of intrinsic value to the 200 strikes. The remaining 19 is going to be our time value on the position. And what we just saw regarding the ATM bell curve, why am I buying slightly in the money? Even though it's close to at the money, but why am I buying slightly in the money here? And going 201 days out in time to August expiration is because we're expecting that slower time decay. Using the profit and loss chart or custom spread tool in PowerOptions, I can analyze that. Let's say 14 or 15 days from now, the stock stays at 191.13. And let's go 2 weeks out. Let's just go to February 13th, a Friday. Happy Friday the 13th. And what, of course, we're going to do is calculate the expected price of our option, even if NVIDIA remains at 191.13 to February 13th. So we'd see that we have an estimated value of 27.19. Over the course of those 12, 13, 14 days, NVIDIA stays the same price. We're expected to only lose 74 cents on the position because we're on the proper side of that time decay curve. Now, let's go ahead and extend our profit and loss chart out a little bit. And let's say we added income method number one, selling a call against the married put. That was essentially Richard's question. How can I compare the time value? Theoretically, we would expect to lose 74 cents even if the stock stayed at the same price in the next 12 or 13 days. And what if we sold a call 12 to 13 days out in time on February 23rd at or above our put strike price? And normally we don't do this in the married put. We wait for the stock to move up per our expectations. But let's sell that 200 call for the 13th of February with a midpoint price of 238. Already we can see what we'd expect to happen, right? We're going to sell this call. It's out of the money from the stock right now. It's at the money, essentially. We're taking part of that at the money bell curve, but we're taking 238 premium in. It does lower our risk down to 7.7%. And of course, we cap the gain here at 3% roughly if the stock moves up to 200. Now, why wouldn't I do this right away? Because I want to wait for the stock to move up as expected when I open the married put, and then I'd sell the call. But this is a way, Richard, that you can analyze the difference in time value. Same exercise using the calculate feature below the profit and loss chart. If the stock stays to 191.13 to our February 13th expiration, what would we expect in change? Again, we see the loss of $74 on our put and the full gain, as we'd expect, of $238 on the call. as we're on the proper side of that expiration time frame and the time decay curve. Now, what if it's just 5 days away? Let's say the stock moves up to 195 5 days away from our position. How is that going to change or meet your expectation of time decay? So we move up and we lose some value on the put at 214. And of course, we only lost maybe 30 cents on the call. Why? Because now we've gone from essentially out of the money a little bit on the call, remember, on our ATM bell curve, to now getting closer to at the money. We've lost some time, 30 cents. We've also lost more on the put. But in order for that to happen, we gained 387 on the stock, so we're still at a profit of 200. It's not so much that I'm losing in this case 214 of extrinsic value on the put option. It's more akin to, naturally, I'm losing 387 of intrinsic value in that case because the stock moved up. So we're losing the intrinsic value on the put. We're gaining time value in our favor on the call as well. And again, even at that price, as we get closer to expiration, let's go 10 days away, February 11th, 2 days before our expiration. We've lost 240 again on the put. We're keeping a lot of that time premium on the put option. We're losing intrinsic again. But we've gained almost 3/4 of the call premium decay in our favor. And again, we still own the stock, so we're seeing that unrealized gain of 387. We are losing 240 on the put from the intrinsic value gain on the stock, plus a little bit of time value, as we saw, that 74 cents initially. And we're gaining 3/4 of the call premium as well. And then, of course, as expiration, as we saw, again, you lose the intrinsic, 251, gain 238, and your underlying is up 387. So you're still looking pretty good. Where are we at here? 195, 374. A little bit more than half the maximum. If we were at 200, another 5-point gain on the position, which would cause the put to decay, but our call would still gain the full 238. So this is how you can view the expectations of time decay. And of course, there are other ways on PowerOptions as well. Another part of your question, Richard, was how can I track this? Well, this is giving you the theoretical expectation of how the time value on your put would change in a married put position versus a potential call that you sold. But you can also track that on a regular basis in the portfolio tool. So I'm going to go to my portfolio, go to portfolios, and I'm going to go to the regular stock analysis view, the view I always use for my married put positions. The stock analysis view adds these extra 6 columns for me here so I can see the position as a whole. Now, we just entered this on Friday during the webinar. Market's not open, so we're just losing bid-ask spread, essentially. We're down $1 on the trade. No gain or loss on the stock, down about 1 cent on the put option because we use the midpoint. Now, there are different things that you can look at. But first, let's go ahead and add that call back in to this married put position. I already know what I want to add, so I'm just going to go position actions, add option leg. We're going to put in that we're going to sell that February 13th 200 call on this NVIDIA transaction, this NVIDIA married put. We're going to get 238. We're going to leave it at midpoint. And because we did this on Friday, let's go ahead and change it to the 30th. All right. And stock price, of course, of 191.13. This is our married put with income method number 1, referenced as a long collar. Haven't gained or lost anything on the sold call yet. It's not pocketed, so we don't count that into, it's counted into the position cost, but we're still just down the dollar, the bid-ask spread sort of on that put option. But we have other views here to do stress test view, performance summary, portfolio valuation, and much more. And you can also sort by symbol now when you have a list of a lot of trades. But what I want to look at first is the Greeks. This is going to give you your Greek information for all of the positions in your portfolio. You know, we've got a delta of 1 on the stock, minus 0.47 on the put that we bought, and minus 0.31 for the call because we sold it, so it's a negative. And that puts us as a positive Greek of 0.22 now for the delta alone. But you also have theta here. And this short call 14 days away, 12 days away at 238, our expectation is to lose at first 20 cents a day. It's not linear, but it's going to gradually increase as we get closer to expiration, while only losing 5 cents of time value on our put option. That's on the assumption that stock stays at the same price, which NVIDIA probably won't, and volatility remains the same. Without a sudden move, it's likely to stay within that same range as well. So that's one way you can view the expectation of the change in time value, or I can go to the options details view directly, and we have just the basic information here, including range in the money, probability, and time/intrinsic value. And as we saw, the time value remaining, 238, on our call option is only 1.3%. Now that's based on the total stock price itself, not the price of the married put, but the total stock price. So only 1.3% that I'm going to gain in time value, where I'm expected to lose 10%, or the current time value, extrinsic value on our put option is that 1905, 1906, which represents 10% of the underlying stock price. But in 12 days, remember, I'm only expecting to see a 74-cent drop in this extrinsic value on our longer term put, because we're on the right side of the time value decay curve for that bought option. We're going to see more rapid time decay in our short option, which we saw with the theta view underneath the Greeks, how much you're expected to lose per day, with the stock remaining at the same price and volatility remaining at the same price as well. So, analysis on that, Richard. Use the calculate feature on the profit and loss chart or custom spread tool for your position to calculate what you'd expect to see with a change of price, and as you get closer to expiration on your stock, well, not on your stock, but on your put option, call option here, near 100% of what we expect it to make, and on your put option as well. And that gives you the gauge. But in the portfolio itself, you can use the options details to see the remaining time value, but the Greeks here under that theta view showing you what you expect per day for the call decay and for the put decay. And you see here it's only about 1/4 the expectation of what we lose in our favor. Of course, it's positive theta here because position theta, it's positive 20.2 cents, negative 5 cents roughly for the put, because that's going to decay away from the value. But this is going to decay at a faster rate over the next 14 days as you expect. And this gives you the comparison of what you would expect on a day-by-day basis. And of course, the sum if you have multiple positions open. So view it in the portfolio, calculate the what-ifs on the profit and loss chart. Those are the ways that you can use PowerOptions to help evaluate the time value decay that you mentioned between your sold call in a married put and the protective put in the married put position. That is on the assumption, of course, that the stock stays the same and volatility comes down. Now, at 27.19 on February 13th, lost less than 80 cents. And of course, what does that also mean? That we gained 238 in 14 days on the call premium. So we've got the time decay curve and the at the money bell curve, Richard, working in our favor there. So we sold here and we bought here, and we bought here and we sold here. We get the time decay in our favor more rapid than the time decay is failing. And of course, that works for the other income methods, Richard, as well, whether we're talking about income method number 6, income method number 5, and more.